If you are looking to sell your rental property or investment property, you may be trying to figure out how you can legally avoid paying taxes on the capital gain. Before 2018, various different types of assets could be exchanged into different assets, but the new law Tax Cuts and Jobs Act of 2017 repealed Section 1031 for all types of property except real property. Let's learn more about avoiding capital gains taxes with 1031 exchange. What is a 1031 exchange? 1031 exchange is often called tax-deferred exchange or like-kind exchange. This allows owners of real estate and real estate investors to sell one property and roll the gains or profits over to another like-kind property or multiple properties. On this page, you'll find a summary of the key points of the 1031 exchange rules, concepts, and definitions you should know if you're thinking of getting started with a Section 1031 transaction. What is a qualified intermediary 1031? Qualified intermediary for 1031 exchange is an independent third party that is responsible for receiving money from the escrow company, making sure all the timelines are followed and send over the money to escrow for the property that is being purchased. 1031 exchange timeline. Following the 1031 exchange timeline is extremely important. From the date you sell your first property, you have 45 days to identify up to 3 properties. Then one or more of these properties needs to be purchased within 180 days from the sale of first property. So the second properties, escrows needs to close on or before 180 days. What is like-kind property? A like-kind property simply means selling one real property and purchasing another real property, i.e. real estate. This means that there is a broad range of exchangeable real properties. For example, a residential rental can be exchanged for a vacant land, for example, or industrial property can be exchanged for shopping center. But you can't exchange industrial property for stocks or purchasing another business. In order for it to be like-kind, it needs to be real property and only real estate. The property cannot be a personal residence and held for investment or rental though, not resale or personal use. This usually means the property need to be kept for a minimum of 2 years or more. In order for the seller to get maximum benefit of a like-kind exchange, property being purchased should be of equal or greater value. 1031 exchange rules exceptions. There are 3 major exceptions. You cannot sell real estate in another country and do 1031 exchange and buy real estate in US. You cannot sell your primary home and do 1031 exchange and buy a rental or investment property. Cannot do a 1031 exchange within related parties, and either disposes of the property short period or time, typically 2 years. Benefits of 1031 exchange. Instead of paying money in taxes, that money can allow you to buy more properties and roll the gain forward. You can save capital gains taxes approximate 15 to 20% depending upon. There could be savings at the state level, this varies by state, so your qualified intermediary should be consulted for this information. The amount of income taxes paid could be reduced or eliminated eventually through step-up basis. A 1031 exchange is an excellent tool that real estate investors and landlords can use to build wealth over time. 1031 exchange rules need to be followed very carefully, and there are a lot of small details. We recommend you seek guidance of a CPA or EA that can help and guide you through the process. Furthermore, avoiding capital gains taxes with a 1031 exchange only works if you have meticulous records and follow all rules related to 1031 exchange.